Great to be here in London today. I've done every one of these Digital Asset London events since it began in 2017, and it's interesting to see, I think Lawrence mentioned it at the start, it's interesting to see how the profile of the audience is so different to what it was at the beginning when it was all tech companies and people talking about visions for a future, and now the institutional delegate profile is impressive and very, very different. But we're here today to talk about this panel: can an asset servicing company survive without adopting blockchain technology? The answer is no. Thank you very much. Now, we're going to dig into that a little bit. I think everyone thinks the answer is no, so it's not going to be a debate on that front, but we are going to dig into the background a bit. But first, maybe you could each do an introduction, starting with you, Angie. All right, starting with you, Philip.
All right, the mic is on, so I'm briefly will start. Philipp Dettwiler. I'm working for crypto finance, part of Deutsche Börse group. I'm heading up the custody and settlement business line.
Sean Mullins. I'm currently responsible for the execution and management of our digital assets and innovation portfolio across Northern Trust.
Hi, Wayne Hughes. I'm in charge of digital assets for security services of BNP Paribas.
Hi, Angie Walker. I run Apex Digital Commercialisation.
Great, thank you all. So we've already established that the answer is no, and I think we're all in agreement on that. But I think the title of the panel, the question it asks, is a little bit sort of broad and general, and the devil is always in the detail, and there's all sorts of nuances to blockchain and how it can be adopted. And I think maybe to start, we'll sort of run through the panel to get your opinion of, what are the nuances? Why it's not just will it be adopted or not? It's there are other factors to consider. Maybe start with you, Angie.
Sorry. Okay. A bit of background from my point of view, because I'm obviously looking at it from the fund administration and the tokenization space. So it is very use case driven. So I think there are particular asset classes and particular products and vehicles that lend themselves to tokenization far better than others. And I think funds are absolutely at the front of that game at the moment, and we can see that as very significant increase in the level of interest in tokenizing either share classes in funds or entire funds. So just a bit of background, Apex Digital is actually part of Apex Group, and Apex are a fund administrator, transfer agent, corporate services. We look after about just under 4 trillion private market assets globally, and we operate in 50 countries. So that gives us a very strong perspective in terms of administration of funds, and what's happening now is we're getting I would say, I'm going to use the word massive, Simon, sorry. We are getting a massive influx of interest. A lot of that was fueled through the acquisition of Tokeny, actually, and a big shout out to the Tokeny team. They did an amazing job. But we're getting a very big influx of customers who are genuinely very interested in tokenizing either share classes in funds or entire funds. And that's not just traditional funds. We've been looking after crypto funds for over 10 years already. But the asset classes and the instruments that are generating the greatest interest are things that can be reused in the secondary market, so we don't just want to tokenize for the sake of it. So things like fixed income funds and money market funds and private equity funds are all of great interest at the moment, and particularly money market funds, where there is an obvious secondary market use around the use of those either in the stablecoin backing of stablecoins in licensed world, or in the provision of collateral management. So I think it depends on the asset class and the use case, but I think the funds market and the fund servicing market is an obvious place for tokenization, for fractionalization, democratization, and also for drives to efficiency through the use of smart contracts, self-executing smart contracts that can drive efficiency across the whole life cycle.
Thanks, Angie. Wayne, to you then, sort of on this, blockchain adoption, what are the other factors we should think about? What's the devil? What is the detail behind the question, in your view?
Yeah, sure. So, and maybe just to give a little context, on our side, we're mainly focused on tokenization, securities, real-world assets, which, as you guys know, is still a little bit immature in general. So I'd say kind of the first thing is we do see a lot of interest from our clients, but we don't yet have a lot of demand, no? There's actually very few clients who are ready to do something in a live environment, no? But what the clients are clearly saying is they expect us as a service provider to be ready and be ready to service them ideally in an operating model that's common across traditional and digital assets. No, so that's one of the, I think, the first factors. And then, you know, as we're saying, no doubt we have to be ready. Now, what use cases do we focus on? What regions do we focus on? What's the pace of adaptation? I think really for us, that's the key points. A lot of our focus has really been around, I'd say, kind of laying the foundation to be ready to move quickly when our clients are ready to really jump in at scale. No, so overall, without a doubt, you know, we believe this is a big part of the future for our industry. It needs to be a priority, but probably it's going to take a little bit of time before we really get, you know, up to scale across the board.
Thanks. Yeah, and Sean, from your side, what are the sort of nuances of this?
Yeah, sure. I'll try not to sort of echo the sentiments that have already been said, but as a custodian and asset servicer, we do very much have to be everything to everyone. So the focus on use cases and client demand is absolutely key. You know, I think the idea of building something and hope people use it is not there. You need to build to a designed use case and focus on that. I think one area that's probably not been touched on yet is participation. So being a custodian and asset servicer, we've seen that tokenisation of real-world assets has very much been driven from the issuer, so upstream to us. And I think to really benefit from this technology, decentralised technology, you need participation from the different roles and responsibilities across the asset servicing ecosystem to really get that benefit. And I think to sort of bring it all to back to where we started, I think the focus on specific use cases does that. I think it helps everybody understand the true value of the tech when they understand the use case, the benefit and the language that's being used. And also that brings participants and flow to the ecosystem.
Cool. And Philip, over to you. I think it was you that said when we had our sort of briefing call that, you know, blockchain is not a silver bullet. It's probably one of many technologies or many things that asset servicing companies will have to adopt. You know, tell us more about that.
Absolutely. The topic we're discussing today, I probably would distinguish about the infrastructure part, but also the investment part. We can love or not love cryptocurrencies. Fact is that if you're adding 1% BTC into a diversified portfolio, your Sharpe ratio basically increases about 1%. That doesn't mean you need to have a major allocation of BTC to your portfolio, but this is why cryptocurrencies are interesting, and this is why there is a push from retail investors towards institutionals. Next to the infrastructure topic, which is probably the main topic we're discussing here on this panel, that is rather the institutional pool. And in that regard, even though we agree here also in the prep call that DLT, the infrastructure, very interesting, it is not the silver bullet for all solutions. Because first of all, you need to analyze your use case if DLT is the right technology for you. As a step number one, you basically need to consider, is there data you're storing? There might be other use cases. The second thing you basically need to ask yourself, is it multiple parties that need to store data? And then the third one is basically, can you or would you like to rely on a trusted third party? If you answer the first two with yes and the second with no, you basically would likely like to use DLT technology, which leads you then to the second phase where you need to contemplate, are you using a public chain, a private chain? Are you using permissioned or permissionless approaches, which gives you a 4x4 matrix for your use case. And lastly, you then will need to check out what are the specifics of your use case so that you can choose the right blockchain from a throughput perspective, from a privacy perspective, and many other cases.
Great, thank you. So, you know, we've kind of established that blockchain is coming, it's being adopted by this industry. I guess the next question is why? You know, what are the short-term maybe benefits first? What do you see as short-term benefits of blockchain technology? technology that's providing the why for this adoption. Maybe Sean.
Yeah, sure. I think to follow on from our first point, really, I think the conversation around benefits has moved on, like the narrative has moved on. So I think the focus on kind of the technological benefits, you know, the efficiency, the lack of reconciliation, single source of truth, all those things we've been talking about for the last 10 years, the conversation's now shifted to improved products and services. So you're focusing, and actually as an organisation as well, that's now started to overlap with our organisation's strategic objectives. So we've now got our digital asset innovation objectives that align with what the corporation wants to do. So stuff like 24/7 markets or 24/5, T+0 settlement, putting assets to better use more generally. And you've got the whole, as Angie touched on there, the whole sort of fund tokenisation and collateral element. Increased liquidity pools, right? And then that's before you even start to look at the power of smart contracts and automation in collateral specifically, looking at sort of automated margin calls, substitutions, elements like that. So I think to not answer your question directly, I think that the benefit conversation is now around enhanced products and services as opposed to operational efficiency. And I think organisationally that's really helped educate everybody because it's a language they understand. If you just go to a management group member and say, right, use this new technology that you're a bit nervous about and you don't quite understand, but it would get you 5% efficiency, that's not really going to fly. You've got to do a lot of work there. If you can give them an operating model with a product that they're familiar with and comfortable with and show them how much this technology can benefit that definitely resonates. So, yeah, I think that's where we're at now.
Yeah, I think, you touched on education there. I think, education is key in all of this. I mean, everyone here is has drunk the Kool-Aid to some extent and so, understands this, but, there's still a large part of the capital markets world that still needs to get up that learning curve. I had lunch with a friend, an ex-colleague, and who's still in the sort of very tradfi part of this industry, and he said to me, Simon, I know what Wi-Fi is, I know what hi-fi is, what the fuck is DeFi? And I think that's very true. There's a whole new sort of technology to learn, there's a whole new words to understand and everything else. But Angie, you're very opinionated about things normally. What can you tell us about the benefits that are driving adoption of blockchain at Apex?
So I wanted to pick up on the point that Sean made in terms of enhancing the products, because I actually think that's probably one of the things that's driving it in the fund industry. So if you look at, and Sandy made some really interesting comments about the whole wallet and account and the fact there's 10 trillion of assets out there in the fund space to be invested in. But if you actually look at the investors of the future, so I think I was on a panel on Monday actually, and I said to them, if you look at the investors of the future, the Gen Zs and the Gen Ys, they don't want this to be prescriptive. They don't expect to be served things on a piece of paper or on a portal and just to tick a box like we did 30 years ago. I'm looking at him because we did it 30 years ago. But they want, that's fine, don't worry, they know you're old. But they want to be able to have flexibility, composability. They want to be able to build their own products. They want to be able to trade 24/7, sit there on a Sunday morning. As my son said the other day when he was day trading, whilst he's at university, by the way, whilst I was worrying about how I was going to cover his next month's allowance, he was day trading on 2 different platforms. He said, you've got to be at it all the time. So they are literally on it all the time. And Sandy made the comment, wallets are replacing accounts. So I think the composability, so by tokenizing and by being able to get right down to the asset level, being able to offer composability and personalization, customization to the end consumers, being able to offer more diverse asset class coverage, so bringing them outside of traditional capital markets into a much more diverse array of assets, as Philipp was saying, being able to offer, different types of assets that offer greater yields and mixing those to bring a better return is what they want. 5% is just not enough. I mean, these guys want 10% plus minimum for it even to hit their radar. And in the next 10, 15, 20 years, 84 trillion of wealth is going to be passed down the line to them. So they are going to have incredible investor capacity to be able to go and invest in all these different things. So I think tokenization is really important because it allows you to get right down to the asset level, and then you can compose and customize what you invest in. I think it also obviously reduces the entry level because you can fractionalize, and that democratizes out a lot of assets that people previously would not have got access to. And one of the reasons that we're tokenizing both share classes in funds and whole funds is for that very reason, to diversify the audience, to make it more readily available. It's a really important part of why we do it. But the other thing is the blockchain and the decentralization piece is actually just about broadening the reach, about, as you said, the unified golden record. What you see is what I see. It's the Bob and Alice, as we called it from my old days at R3. So it's really important we're all looking at the same information at the same time, and there is only one version of the truth. And I think that will become increasingly important as we become more industrialized. And I'd say the only other thing that's really important, 24/7, it's coming. It's not going to disappear. And in fact, we've just spent the last 12 months massively increasing our operate model and our support model at Apex, because we were supporting traditional funds for 24/7 for money market funds and stablecoins. And that's been a huge lift. But that's where the market is going. They want to be able to access their investments and to redeem and subscribe 24/7. And we can only do that through the provision of moving that value in those assets on-chain, and also moving the cash on-chain through the use of stablecoins. So I think it's a combination of different reasons that will bring tremendous change, particularly in the fund industry.
Thanks, yeah, and you mentioned stablecoins. We'll come back to them in a moment, I think. But Wayne, what about at BNP? Is there any other sort of innovation or benefits you see from the adoption of blockchain?
Well, I'd say I'd have to concur with the benefits that have been highlighted already. What I might add is a couple interesting trends that we're seeing, which makes us have hope that some of these shorter-term, nearer-term benefits will really be achieved. So one from our perspective is collaboration. What we're definitely seeing now is a lot more willingness, especially among the banks, to work together on standards, common initiatives, on and on. You know, clearly this is an ecosystem play. Up to now, it's been quite fragmented, which again, probably made sense at that point in time. It was easier to experiment with a smaller group of people, but clearly that doesn't scale. So the fact that there is a lot more willingness and active collaboration, we believe, is a very interesting trend. The other's been kind of mentioned. No, I mean, what we saw at the beginning, even in our conversations with clients, was there was almost 100% focus on saving cost. Now, that was kind of the benefit everyone was seeing, which obviously we expect that to be one of the benefits, but it didn't seem to be enough to really move the needle, let's say, to really get people really involved. We're seeing a lot more focus on, hey, what can we do new with this technology that, again, maybe it wasn't impossible before, but it wasn't so easy. You know, and I think things like collateral mobility are a great example of that. No, really allowing us to take a real step forward. So, you know, really kind of extend the value of our existing services.
Great, thank you. So we've kind of established that it's happening, and we know why now over the benefits. But what about the what? You know, what might stop this? What are the challenges going to be? And maybe Philipp, over to you first.
My strong belief is that the technology is basically ready, institutional technology. That was probably the bottleneck up to 2019. And then the bottleneck up to, I would say, end of 2024 was regulation. But now with the US kicking in, really spearheading the industry, I would also say this is no longer an argument. In my personal opinion, what is holding back the adoption, be it tokenization, be it cryptocurrencies, stablecoins, etc., is rather the minds in the boardrooms. Adoption, that when they hear BTC, this is not all evil, there is also a very valid technology behind it you can use for the better.
And Sean, what about from your side? You know, what do you see as the challenges, the hurdles that are going to have to be overcome?
Yeah, I think I completely agree. I think the theme I know we was talking about as we were preparing for this this session. Actually, I think there's far more focus now, and I think the education is starting to catch up. I think back to Wayne's earlier point as well. I think we're starting to see client demand in specific areas now. The conversation's not so much as what are you guys doing? It's more, are you able to do this for me? So I think now that the regulatory hurdles have been lifted, if you create an environment where your organisation understands what it is that you're looking to do, you've got the client on or the end user that's requesting you to do these things. It's kind of at the stage now where you put your money where your mouth is, so to speak, right? You have to fund this now. It's happening. You don't want to be left behind. That can lead to some interesting conversations internally. But ultimately, I think we're definitely in the best environment that I've seen in this space as a big global institution to start adopting. So I think the excuses, to your point, Simon, I think the excuses are starting to run out now. I think organisations need to move.
And what about sort of, I mean, to anyone, but what about kind of other side effects? What about things like, you know, fractionalisation of liquidity? What about interoperability? I mean, there are kind of side effects too, don't you think?
Okay.
I absolutely do agree, and there are always two sides of the coin. Just as one example, as a financial market infrastructure provider, you really need to contemplate what happens if you're introducing stablecoins, because you're not paying interest on fiat, and now all of a sudden you're losing this interest income. That's in the hundreds of millions of revenues that are basically gone because you're not paying interest with stablecoins. So naturally, you are looking for solutions like, for example, tokenized money market funds, which is quite interesting in that perspective. So there's always flip sides of what is possible and what not. So it's, as I said, as you quoted me before, not everything is a silver bullet solution.
And Angie, maybe to you, I mean, what about data sovereignty? I think that's something that you mentioned before.
Yeah, so data sovereignty is a really big issue, particularly in certain jurisdictions, and I probably had more to worry about, certainly in the data sovereignty space when we were doing things at Chainlink, and we were worrying about the cross-chain interoperability, and then you start to think about, you know, distribution of minting and distribution of stable coins cross-jurisdiction. You've got to worry about that. But so data sovereignty is a difficult issue. We've got to be able to, by virtue of being decentralized and blockchain-based, of course, it allows for the free flowing of assets and tokenized cash between jurisdictions. What you have to do is look at the regulatory framework that sits around those. So if you look at something like the dirham-denominated stablecoin in the UAE, it's only currently licensed for domestic use. So although quite legitimately in a technical sense, it could be moved into another jurisdiction very quickly, instantaneously. At the moment, the licensing doesn't allow it to happen. So what we've had to do as an industry, and actually Apex worked very closely with Chainlink on the cross-chain elements and things like the compliance and the policies. We have to be able to stop certain data from, even though we're using blockchain, we have to stop certain data from leaving certain jurisdictions, and a good example is Saudi Arabia. So all data stays within the jurisdiction, but we still want to be able to leverage decentralization. So there's some very interesting compliance and policy and governance requirements that, you know, 3 or 4 years ago we didn't have. We didn't have the capability to implement on blockchain-based and decentralized use cases. We do now have that. It's actually very well advanced, and there's quite a number of real-world scenarios that have been demonstrated where we've used products like Chainlink and Apex are using them as well to actually control the sovereignty of the data and to control the use of certain assets and cash within various jurisdictions. So I think technically we're able to solve for that now, both on public permissioned and on private chains. So but it's a very challenging subject.
I mean, stable coins have come up a few times now, and it's certainly true, isn't it, that if blockchain is going to be successful, you need some form of digital cash, and it's pretty easy to say that stable coins are that silver bullet. But actually, are they really? Because there's lots of challenges with stable coins. I mean, what's your view, Wayne, on stable coin adoption and the challenges around that?
Yeah, I think first, I have to say that it's, at least from our perspective, been amazing how the conversation's changed over this year. I think if we went back 12 months, we probably wouldn't have bet too much on stablecoins being a clear, critical component of our industry going forward. Talking about tokenization of securities, real-world assets. So I think that's, in and of itself, has been very interesting and actually very positive, no? I mean, one of the first benefits, I think, from our perspective, or kind of an indirect benefit, is this has created a renewed excitement, no, in the industry. I think a lot of us were impatient to see things scale up, and knowing that the payment leg was one of the biggest challenges that had to be addressed. So, you know, do we believe stablecoins are the best and the unique solution to manage the payment leg for tokenized securities? Personally, we would, let's say, not believe it is the unique solution. Is it maybe something good enough to take the next step? Definitely start to believe that. But I'd say overall, from our perspective, when we talk about the cash leg, we do believe that the future is probably more a combination of different means of payment for different use cases, different regions, et cetera, but okay, with stablecoins being now in the mix.
Yeah, but you know, there's only, in the fiat world, traditional fiat world, there's only one US dollar. In the digital world, I mean, I don't know how many US dollar stablecoins there are, but there's a lot. And Sean, what are the challenges around that?
Yeah, there's opportunity and challenges. So if I put sort of my Northern Trust head on, the opportunity is, and we do this at the moment, we're able to be the custodian of their reserve pools, right? Which is which is good business. It's traditional custody. It works. I think the challenge is kind of the challenge we've got more broadly with digital assets is that interoperability key, right? We're very much the plumber of capital markets, and we have to provide those connections. We're not going to want to do that to 20 US dollar denominated stablecoins networks. So I think that interoperability key is something that we do need to overcome. As an organisation, like all of our peers, we are going to start to push into how we can service and hold those stablecoins on behalf of our clients. Again, the same problem, right? The traditional side is easy to us. We've overcome that. We've done that for many, many years. But just that connectivity is a problem. And I think more broadly, beyond just Northern Trust, there's economical impact, right? That use of that US dollar denominated stablecoin is replacing the use of a local currency. And what does that mean? What impact does that have? I know there's been a number of articles this week looking at emerging markets and the impact of that there. So I think without making the panel too boring and agreeing completely, I think to Wayne's point about that this could be one of many, I think that's absolutely right. And I think that's probably will make everybody feel far more comfortable if that's the case.
Yeah, and of course, if you're moving from stablecoin to US dollar stablecoin to another US dollar stablecoin, you know, there is bid offer leakage, right? I mean, you know, there's a cost to all that. But Phil, over to you. What's your thoughts on the stablecoin side?
I just wanted to say, yeah, maybe boring, but I would agree with Wayne as well. There is probably indeed a bifurcation of solutions. If you're using stable coins or continue using fiat for settlement, I think both rails do have their right for existence, particularly in Europe where payment systems are fairly efficient. But coming to the point that we are just launched AnchorNode, a off-exchange pledging solution 1 week ago, brings me to the point that the settlement is just one side of the coin, because the asset side is almost as, or I would say even more important in such a setup. Because today, off-exchange settlement is in TradFi, nothing special. That exists in some ages, but now with the crypto industry, you can move assets quicker, so you are much more capital efficient. So yes, the traditional finance prides itself that now they're moving from T+2 to T+1. What a huge achievement, whereas we basically could settle instantly atomic DVP settlement. And I think this is the way to go, that eliminates 100% the counterparty risk and increases your capital efficiency.
Great, thank you. We're approaching sort of the end of our time up here, so maybe as a sort of a closing question to each of you is around how long is this all going to take? You know, how long will this adoption take? And maybe also, in terms of phasing, what might happen first or what might take longer? Angie, what are your thoughts around that?
So I'll only comment on the fund space because I think funds are going to move a lot faster than a lot of other instruments or asset classes or products. I think in the fund space, and I think Larry Fink referred to this in his letter to his shareholders, he reckons in the next decade, most funds will become tokenized or represented in a digital form, either in part or in whole. I think probably in whole, to be fair, at the rate they're going at the moment. So I think it will be very fast in the fund space. I don't think that replaces the existing technology. It isn't a silver bullet. There are certain parts of the fund administration lifecycle that will remain on traditional technology, but we've already shown that we can integrate seamlessly between the blockchain and traditional technologies anyway. But I think from an asset class perspective and from a product perspective, I do think within the fund space it will change over the next decade. I think other instruments and asset classes will be slower because they'll be held back by regulation or by less demand, but I think you will see a big shift in funds over the coming 5 to 10 years.
Wayne, anything to add? Timing, phasing?
Yeah, I think, I think if we were talking about at what point will we have everything natively issued on a blockchain, I think we're quite a ways away from that. I do think the trends and the intention now of some out there to start tokenizing or making a digital twin, let's say, of existing assets, like the recent announcement of NASDAQ, I think will be part of the spark to get some more activity going. But I think that transition really to a fully digital world is going to take quite a while. In the meantime, I think things like cross-border payments, collateral mobility are probably really going to be the ones that start to get a little bit of critical mass over the nearer term.
Okay, Sean, where are we going to be in 5 years?
Probably sitting here.
You meant to say retired.
Yeah. Oh, that'd be nice. Yeah. No, I think I think sort of following sort of the decade concept, I could really see in 5 to 10 years the conversation being completely different. I think there may not be this idea of, are you going to adopt digital assets, are you not? It may just be how quickly are you going to be able to service 24/7 markets, T+0? How quickly are you going to be able to sort of break down the barriers between the different asset classes so they're all just tokenized forms of value. So I could really see, and that sort of comes back to the beginning point about blockchain being one of many technologies that an asset servicer is going to need in order to prepare itself for the future. So to sit on the fence completely, I'd say 5 to 10 years, I think the conversation will have gone beyond digital assets and more around services.
You mentioned 24/7 trading. Does anyone really want that, do you think? But anyway, let's
My
not go
son
there.
does.
Let's not go there. Phil, over to you to close
Thank you very
out.
much, Simon, for the question, which is a little bit the tricky one and the dangerous one. So I don't want to answer it by a timeline because our industry was rooting for imminent adoption now for years. So it was always said, it's now, it's kicking in, tokenization is coming. So my answer would be, I do not know when mass adoption will kick in, but I will say this, for the incumbents not ready with their infrastructure for when it's kicking in, they will be crowded out of the market. So it is absolutely vital to be ready, and I believe all the panelists here represent companies that do help incumbents to be ready for the future.
Great, thank you. Well, sadly, we're out of time, so it's the end of the panel. But the good news is it's time for lunch, I think, isn't it, Mike? So.
The smell of food is wafting in, so thank you very much. And we're back here at 1:15.